economic shocks at the moment from Israel's and the United States war on Iran have made it much harder for African nations to raise funds for development abroad. That said, a new report published by the Africa Finance Corporation argues that, in fact, the continent's domestic capital base is now at a scale that exceeds external financing flows over the last decade. And the authors of this report argue that it's more than enough to fund the continent's own growth and industrialization needs. The AFC's State of Africa's Infrastructure Report 2026 was launched on the sidelines of the AFC's inaugural Africa We Build Summit in Nairobi. CGTN's Uche Okoronko was at the event. She filed this report.
Africa's richest man, Aliko Dangote, plans to build a refinery in East Africa identical to his 650,000 barrel a day refinery in Nigeria. He revealed this for the very first time on a panel at the Africa Finance Corporation's inaugural Africa We Build Summit in Nairobi, where we saw him also challenge Kenya's President William Ruto and Uganda's Yoweri Museveni to commit to a strategy.
Even now, I can give commitment to the two presidents that were here. If they will support the refinery, we'll build the identical one that we have in Nigeria, 650,000 barrels, with the likes of Afrexim Bank, with the likes of Africa Finance Corporation, with a lot of support from other financial institutions. Following these two, there's nothing we cannot do in Africa. That's why we, as a group, we have now launched between now and 2030, we're investing $40 billion in various fields.
I dare say, ladies and gentlemen, we have this, in this room, we have the political leadership, we have the industrialists, we have the financiers to transform our continent, and we must waste no time looking any further.
Much like this exchange, this year's Africa We Build Summit opened the floor for government officials, leading infrastructure financiers, fund managers, investors, and industry leaders to not just talk money, but also realize deals for infrastructure projects across Africa. However, this year, a new report by the Africa Finance Corporation is advocating for a different approach. Now, Africa has just over $2 trillion in non-bank domestic capital pools. Now, here at the inaugural Africa We Build Summit here in Nairobi, the Africa Finance Corporation says that is more than enough to significantly fund and provide the capital needed to fund Africa's development. The AFC's 2026 State of Africa's Infrastructure Report advocates for a new kind of funding, one that taps into the over $1 trillion in domestic pension and insurance assets in Africa, or the $530 billion in central bank reserves as of 2025. The message here is Africa can do it all by herself. The constraint is no longer capital mobilization, but how to deploy it. However, the critics point to a fragmented system where risk is still a very real concern. Well, I sat down with the AFC's chief economist and director of research and strategy, Dr. Rita Babihugan-Sanze, to get some insight into how stakeholders, both public and private, could get on board with a plan like this.
The safety point is a real one. You know, it's a valid one. And so what we're saying is that we talk about this intermediation that needs to happen, this sort of building out of the financial architecture. Part of that has to do with how do you build guarantee structures, safety nets, that essentially, provide a kind of a credit enhancement for pension funds, right? So whether it's first loss structures where the developed, African DFIs go in first and provide that first layer of safety for the pension funds to come in on top.
Now, this is not necessarily a new concept. Initiatives such as the Lobito Corridor, as well as emerging national infrastructure financing vehicles like the Kenya National Infrastructure Fund, prove that it is possible to integrate systems where capital and policy align with major infrastructure projects. Ucheo Koronkwo, CGTN, Nairobi.
All right, then let's bring in Tilewa Adebajo, CEO of CFG Advisory, joining us live on the program from Lagos. Thank you for your time this evening, sir. I want to start with the situation with the Dangote Refinery in Nigeria. We saw a lot of arguments in the country over the importation of refined fuel products, even as the refinery was coming online, and it can meet Nigeria's domestic demand. For this proposed refinery in East Africa to work, countries would have to phase out refined fuel imports, won't they?
Indeed, but it's also important that we dimension this, and I think the whole essence of the African Continental Free Trade Area, this is a good way to start. It is the entrepreneurs that will make this happen. And just to dimension what we're talking about, Africa as a whole produces between 7 to 10 million barrels of oil a day, not to talk about its reserves. That's like 10% of global production. Where we have the shortfall is in the refining. Our consumption is about between 4 to 5 million barrels a day, but currently we have a shortfall of about 1 million to 1.5 million barrels a day in terms of refining capacity on the continent. So it's quite ridiculous that we have the production of the oil, but we can't refine it. And that's the same problem in Nigeria. Now Dangote's refinery came online, and not only does it meet domestic production, it's exporting to Europe. And of course, he's now building the second phase of the refinery. So I think what we should do is that these are the exact opportunities we're talking about when we talk about an African Continental Free Trade Area. And Dangote has the EPC capacity to deliver this project. And we have companies like the African Finance Corporation you've just been talking about, and the Afri-Exim Bank that can put together a syndication that could fund this transaction with a lot of other investors across the continent. So for me, I see this as a no-brainer.
And just in terms of stimulating demand, right, under the CFTA, because these are countries that have simply said, you know what, let's take in each other's products at preferential rates. So we could essentially be creating the price signal, right, to essentially stimulate domestic demand and create the domestic market, right, for that product.
Exactly. And I think, you've hit the nail on the head. And that is really what we need to do. We need to begin to create value. We should stop importing and, making refineries in Europe more profitable. We have the capacity locally. We have the oil. We have the gas. The production is there. It's just a question of the refining. And I think that these are the strategic investments we need to make across the continent, not only in West Africa, but also in Central Africa, Southern Africa, to make sure that with the lessons we're seeing from the closure of the Strait of Hormuz, Africa is on the Atlantic seaboard and also on the Indian Ocean. So our own supplies have not been affected by this. And Dangote right now is supplying a significant amount of his Jet A1 fuel to the European markets because we don't have any conflict on this side of the continent. So that is a strategic advantage, not only to supply the Europeans, but I think the lesson now is that we need to use this as a strategic investment for energy security and energy self-sufficiency in Africa.
Crude oil production in East Africa is still, relatively speaking, except with the exception of South Sudan, is still in its relatively early stages. From your perspective, does it make it easier for a potential refinery in the region to source the crude oil it needs to operate as compared to the experience the Dangote refinery had, where a lot of Nigerian crude had already been committed, and therefore the refinery had to buy oil from foreign sources, including Brazil and the United States?
Yes, don't forget the Dangote refinery, for about 15, 20 years in Nigeria, there was no local refining. So that oil was committed. Eventually, those contracts are going to expire, and Dangote will have the rights on that crude oil production. That is just a question of time. But the question is that we have oil on the continent, and we can source oil from Angola, from Nigeria, from Chad, from Egypt, from Algeria, and all over, pending when the East Africans bring on their capacity to the markets. So setting up these refineries and getting oil and getting committed oil is something the African Union and the politicians should lead, to ensure that oil is being committed for refinery for self-sufficiency. So it's just a question of time and having a deliberate strategy. We need to be intentional.
One last question for you. The refinery, the Dangote refinery in Nigeria, will be listed at some point. Aliko Dangote has made that quite clear. Do you think, though, that it should come to market as a standalone company, or does it make sense to sort of package it with the East African refinery? Because he said that he wants to make this a Pan-African listing, right, with shares at the JSE, at the Nairobi Securities Exchange, in Lagos, perhaps even in Casablanca and Cairo.
Well, it's important he has that Pan-African listing, because he can also go to the markets for another rights issue to fund the East African operation. So it's a question of having a holding company and having each subsidiary being completely differentiated. But I think it's still quite early in the days to say so. But the benefits of having a Pan-African listing is that he can source capital, if he needs it, for expansion, across, the continent as a whole. And when the refinery in East Africa eventually it comes off the drawing board, then you could now look at the corporate finance strategy in terms of the best options to be able to look at that. But I think that it's a step in the right direction, because currently we have a shortfall of about 1.5 to 2 million barrels of refining capacity on the continent, despite the fact that our production is between 7 to 10 million barrels a day.
Indeed. Tilewa Adebajo, CEO at CFG Advisory, joining us there live from Lagos. Thank you.